Since August 1st, the S&P 500 has pulled back 10%, essentially in a technical correction. Corrections are never fun to go through as an investor, but at the same time, if you're a long-term investor, a patient investor, these are opportunities you're getting to invest in high-quality companies at cheaper valuations. So in today's video, we're going to take a look at 5 of the best stocks that you can buy in the month of November. All 5 of these stocks are trading at great valuations, huge discounts, and all 5 have huge upside moving forward. So before we begin, do me a huge favor, smash that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and let's jump into it. Hey everyone, Mark Roustan here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. All right, in today's video, we're going to take a look at 5 of the best stocks you can buy in the month of November. And let's begin with RTX Corporation, stock ticker RTX. RTX, as you may know, is formerly known as Raytheon Technologies, and the company is one of the largest U.S. defense contractors. The company currently has a market cap of $114 billion, and over the past 12 months, the stock is down 12.5%. However, since the end of July, shares of RTX are down nearly 20%, and that is due to the fact that at that time, the company announced engine recall related to their Pratt & Whitney division. The stock fell 12% on that day that this was announced, shedding more than $10 billion in market cap off of the company, which looked extremely overblown at the time. And I continue to believe that this is overblown, which is why I dipped and started buying the stock. And what gives me even more confidence that this is overblown, that the company just announced a $10 billion share repurchase program. This is an accelerated share repurchase program as well. A management team that announces a $10 billion share buyback plan right now doesn't sound like one that's all that concerned about this engine recall. Analysts are currently expecting RTX to generate 2024 EPS of $5.46 per share, which equates to a forward price-to-earnings multiple of 14.4 times. For comparable purposes, over the past decade, shares of RTX have traded at an average earnings multiple of 18 times. Currently, 22 analysts cover the stock, and they have an average 12-month price target of $91 per share, suggesting 15% upside from current levels. In addition to that 15% upside in the share price, RTX also pays an annual dividend of $2.36 per share, which equates to a dividend yield of 3%. The company has increased their dividend for nearly 30 years, making them a dividend aristocrat, and they have a 5-year dividend growth rate of more than 5%. Before we move on to November stock number 2, let me tell you about today's sponsor, which is Snowball Analytics. If you're a dividend investor of any kind, you could have growth stocks, but if you have dividend stocks, dividend investing is a journey, and you want to be able to track your performance. This is where Snowball Analytics comes into play. Snowball Analytics, they have a primary dashboard, which is going to help you track all of your current positions. Within the dashboard, you can see they have a dividend calendar, which not only will tell you your annual dividend income, so you can track your progress towards your annual goal, but you'll also see when you will be getting paid, from which stocks you will be getting paid as well. In addition, within Snowball, you can also research stocks that either you already own or want to own, looking at prior financial results and valuation metrics to help you make more well-informed decisions. When researching a stock, you will find a rating that Snowball assigns various stocks which look at the financial stability of that particular company. The higher rating, the safer the company. It takes into account a number of different metrics to assess that company's financial stability and safety. If you're interested in checking out all that Snowball Analytics has to offer, you can do so completely free for 14 days. If you go to snowball-analytics.com, you could sign up for that 14 free day trial. I'll also leave a link down in the description below. All right, now moving on to November stock number 2, which is Lowe's Companies, stock ticker LOW. Lowe's Companies is actually one of my favorite dividend growth stocks on the market for a number of years. Not only do they offer strong dividend growth, consistent dividend growth, but they also, as a company, offer great share price growth as well. Not something that has been the case here, though, in 2023. Lowe's currently trades with a market cap of $107 billion, but over the past 12 months, the stock has fell 5%. However, since September 1st, shares of Lowe's have pulled back 20%. Again, this is giving us patient long-term investors an opportunity in a high-quality company at a low valuation. So why is Lowe's under pressure so much since September 1st? Well, the market as a whole has pulled back, but also we have seen the housing sector pull back as well. Mortgage rates up over 8% for the average 30-year rate. That is just a huge amount, and it's pricing out a lot of first-time buyers, which tend to be more than 40% of all sales. So as we know, the housing sector can't stay down forever, and neither can Lowe's. Lowe's is already a high-quality company, but now it's just trading at a cheap valuation. So this gives us long-term investors an ability and an opportunity to chip away and add more assets to our portfolio. So as I mentioned, Lowe's looks rather cheap. Let's take a look at how cheap they are right now. Analysts are looking for Lowe's to generate 2024 EPS of $14.53 per share, which equates to a forward price to earnings multiple of just 12.8 times. For comparable purposes, over the past decade, shares of Lowe's have traded at an average earnings multiple of 20 times. That is a sizable difference. 35 analysts currently cover the stock, and they have an average 12-month price target of $244 per share, suggesting 32% upside from current levels. In addition to some major upside, the company is also one of the most consistent dividend growers on the market today. In fact, Lowe's is a dividend king, having increased their dividend for more than 50 consecutive years. In fact, they've increased it for more than 60 consecutive years. The company currently yields a dividend of 2.4%, and they have a 5-year dividend growth rate of nearly 20%, which is quite impressive. November stock number 3 is Merck & Company, stock ticker MRK. Merck & Company is a pharmaceutical company, one of the largest on the market today, and they have actually been one of the few bright spots in the healthcare sector, which as a whole is actually down 4% on the year. Merck & Company has a market cap of $263 billion, making them one of the largest pharmaceutical companies, and over the past 12 months, shares of Merck have climbed 7%. However, similar to the other stocks we've looked at so far, shares of Merck have given back more than 10% over the past 5 months. Merck recently reported their Q3 earnings, which showed a beat on both the top and bottom lines. Revenues grew 7% year over year, led by their top-selling drug Keytruda, which saw 17% year-over-year growth on $6.3 billion of sales. Based on the strong Q3 results, management also increased the company's full-year guidance, increasing both sales and EPS guidance. Analysts are looking for Merck to generate 2024 EPS of $8.43 per share, which equates to a price-to-earnings multiple of just 12.3 times. For comparable purposes, over the past decade, shares of Merck have traded at an average earnings multiple of 15.3 times. Not quite the difference we see with Lowe's, but still a sizable difference nonetheless. 28 analysts currently cover the stock, and they have a 12-month price target of $123, implying 16% upside from current levels. Merck is yet another dividend growth stock, with a dividend yield of 2.8% and a 5-year dividend growth rate of 10%. The company has hiked the dividend for 12 consecutive years and counting. November stock number 4 is the Hershey Company, stock ticker HSY. The Hershey Company doesn't really need that much of introduction, as they are one of the world's largest candy operator. And the company has been on my watch list for some time, as they have been in a downtrend since the start of May. Hershey currently trades at a market cap of $40 billion, and over the past 12 months, the stock is down nearly 20%. Since the start of May, as I mentioned, shares have dropped more than 30%. Some of the pressures that have weighed down on Hershey is inflation, higher input costs, and the only way to combat this is try and pass a lot of that on to consumers. The other thing that has really weighed on Hershey's, it's also weighed on the likes of Coca-Cola and PepsiCo, has been the talk of this miracle weight loss drug, something like Ozempic, where we believe, or investors are now believing, that the US is all of a sudden going to be this healthy nation. I'm not really buying any of it. The only thing I'm buying is these high-quality companies at low valuations. The company recently reported their Q3 earnings that beat on both the top and bottom lines. Revenues rose 11% year over year, and the company is expecting full-year EPS growth between 13 and 15%, which is actually pretty solid given the current environment. So definitely a testament to the company's management team. Analysts are looking for Hershey's to generate 2024 EPS of $10.23 per share, which equates to a price-to-earnings multiple of 19 times. For comparable purposes, over the past decade, shares of HSY have traded at an average earnings multiple of 24.5 times. Currently, 24 analysts cover the stock and have an average 12-month price target of $229, implying more than 20% upside from current levels. Hershey's is yet another dividend growth stock that has a 5-year dividend growth rate of 10%, and they have increased their dividend for 13 consecutive years, and currently, shares of Hershey's yield a dividend of 2.5%. Before we move on to the next stock, let me tell you about a special promotion going on over at Webull. If you're new to investing or just looking for a new brokerage account, or you're just looking for some free stocks, then check out Webull. Right now, if you open a new Webull account, deposit any amount of money, you can deposit $5. They will give you up to 12 free stocks that could be valued up to over $30,000. Definitely check out the link down in the description below. November stock number 5 is Meta Platforms, stock ticker META. Now I know Meta Platforms isn't a dividend stock or a dividend growth stock. They are a growth stock. And they're not just any growth stock. They've actually been one of the top performing stocks in 2023 alone, really only trailing the likes of Nvidia, which is up 181% in 2023 alone, whereas Meta is up only 131%. Meta currently has a market cap of $771 billion, and as I mentioned, they're up 131% in 2023. Meta shares have performed fantastically for much of the year. However, much of the pressure has come in recent days and weeks, with the stock falling 12% in the past few weeks alone. Now, this may not sound like a lot for a company that's up 131%, but believe it or not, when we're going to take a look at valuation, it's still a cheap stock. Meta recently reported their quarterly results that beat expectations on both the top and bottom line quite easily. Revenue during the quarter grew 23% to more than $34 billion, and profits nearly doubled from the prior year at $11.6 billion. Now, 2023 has been labeled the year of efficiency by CEO Mark Zuckerberg, who's really focused on bringing costs down, investment costs, as well as bringing expectations and their labor costs more in line with those expectations as well. The quarter was a huge blowout, as I mentioned, but the thing that spooked investors was the soft or cautious Q4 guidance moving forward, particularly around lower ad spend. We saw a similar fate for Alphabet, which is a close competitor to Meta, but that was more focused on a miss on their cloud revenue results. So how cheap could a growth stock like Meta, that's up 130% year to date, actually be? Let's take a look. Analysts are calling for Meta to generate 2024 EPS of $17.43 per share, which equates to a forward price to earnings multiple of just 16.5 times. Over the past 5 years, shares of Meta have traded at an average multiple of 23 times, and over the past decade, closer to 28 times. This is a company that is expected to generate EPS growth of 66% in 2023, 22% in 2024. This gives Meta a PEG ratio below 1 at 0.75, suggesting shares are quite cheap based on the multiple you're paying compared to the growth you're getting along with that. 56 analysts currently cover shares of Meta, and they have an average 12-month price target of $370, implying nearly 30% upside from current levels. Definitely a big-time growth and a ton of growth still baked in to this stock. So there we just looked at 5 companies, 5 of the best companies to take a look at in the month of November. Not all of them, as we saw, were dividend stocks. Most of them were dividend growth stocks. Down in the comments section below, let me know which of these 5 stock picks that I just went through, which are all based on my opinion alone, do you like best? Let me know down in the comments section. And if you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel so you're notified anytime we drop new content, and we'll see you in the next video. Take care.